We're live.
Yes, we are live.
Hi, everyone. Welcome to our market talk. So today's talk will be a little bit different. It's our first time doing this talk here on YouTube. So I apologize if we have some technical issues, but hopefully not. And also, for those people who are subscribers to our channel, you can also send questions to the chat, and in the end of the conversation, we will make sure to answer them, if any. Okay, so hopefully you can hear me and see me. So hi, Raphael. Hi, Brian. Thanks for joining. Yeah, let's start. So Brian, what do you see in the markets and what are you trading?
Yep. It's been a pretty good couple of weeks. Through December was just absolutely brutal, trying to find where the top was going to be and avoiding getting squeezed to the upside. So there was a bunch of marks I took kind of at end of November into early December, trying to figure out where this would be. But the really big one that I finally was able to nail it was into the CPI report, and then FOMC kind of around the 13th of December and the 14th of December. The big thing I noticed then was we were in positive gamma at the time, and people were hedging, but everyone was hedging upside protection. So like into the CPI report and even to FOMC as well, you saw like VIX rising a lot with equities. And that was people chasing calls big time up to the upside. What happened was the call wall ended up landing right around 4,100 at the time. And off of the CPI report, we got a really different reaction than what we had off of the last CPI report when we went up 6% in a day. In that scenario, we went up to 4,100. I knew people had chased calls big time the day before, and then we weren't able to go past it. We went to the call wall and rejected it. So once I saw that, that was my trigger to then start laying on shorts and sticking with them for the potential then of breaking down into FOMC. And then so you got a bit of a pullback after the CPI report, but then we ended up pushing back. People were still hedging upside because they thought Jerome Powell was going to come out and be dovish and give us a Santa rally. And so you rallied on the same day as FOMC, went back, tested near there, but then just started falling. And then from that point forward, on all the rallies on both the CPI day, as well as the small rally we got on the day of FOMC, stock bond correlations were strengthening, sector correlations were strengthening, all into that test midday. And then once we failed, there was really nothing to save the market. At that point, we quickly broke into negative gamma, which I think at that time, the gamma flip level was around, I want to say 4,000 on S&P, around 400. We broke down, correlations remained strong the whole time. And Hearst Exponents actually really helped call this one as well, because what you saw was out of that report, Hearst Exponents started strengthening into the down move. And anytime we got any intraday up moves, kind of like yesterday, Hearst Exponents were weakening. So that allowed me to stick with the trend and kind of at this point still identify that momentum was kind of building to the downside for me. So rode that move completely for the 4 days. I haven't covered anything from what I loaded CPI on the CPI and FOMC days. I've only been adding to shorts. I literally had not covered anything. Took a 2-day bounce here the last couple of days. Wore that squeeze yesterday. Wasn't great, but the same thing happened on the up move. Both the 2 days we had green days. Hearst Exponents weakened on both of the bounces, and correlations re-strengthened yesterday. You had sector correlations go back to an extreme, and stock bond correlations were moderately positive. And so that led into then today's claims and GDP report and led to the puke that we saw today. Now today we kind of went below it was currently the put wall at 3,800, 380 on SPY. And I thought we'd go no bid today, but people came in and they sold puts, and I assume they rolled them lower. So this probably opens up the downside potential tomorrow on the PC report. Into the close today on the down day, we had sector correlations at absolute extremes, so that's a lot of risk there. Stock bond correlations aren't really playing ball. Those are moderately negative / positive, pretty much neutral. So that's kind of interesting. That bonds closed completely flat today and didn't take part in the drawdown at all. whether that's supportive into tomorrow's PCE report. I'm not sure. If stock bond correlations went like deeply negative today into the down move in stocks, then maybe. But for tomorrow's PCE, like everyone's forecasting like the steepest drop off in core PCE the entire year. And so that matches what we got in the last CPI report, but that gives the edge then to the hawkish side. So if PCE comes in line or moderately hawkish, you have a lot of risk building now in deep negative gamma territory, right at 380, which is a big level going into the PCE report tomorrow. So risk of getting squeezed because we're in negative gamma. It's very unstable. You got big volatile moves either direction. But I think you could get a continuation. We should get a continuation lower of this move on Friday. So didn't cover anything today, still really short, and we'll see how it goes. But that's where I'm at there. And yeah, if anything changes like that, if like on today's move, correlations were weakening, yet stock bond correlation kind of doing the same thing. But if sector correlations weakened, then I would have looked to cover some. But what I saw with the negative gamma move intraday, where we squeezed off of like 37.50, I don't think that's bullish. Like some of the technicians might call it a fake breakdown or whatnot out there, and they might think we're going to rip higher. I mean, that's people they closed puts lower when we went pretty low intraday, which was beyond a 1 standard deviation move, which is at 38.11. And they squeezed it back up. And so now they have the opportunity to roll it into the 3700s. And I think we go there. So we'll see. We'll see how it goes tomorrow. And one big thing is that I expect now, and Bai, you can tell me if this isn't the case, but I would think that Hurst exponent strengthened after the down move just because of what I've seen. We've had 4 days in a row, down moves, Hurst strengthened, 2 up days, they weakened, and now I would think they re-strengthened again if the trend is continuing on that tomorrow. And so that would look for us to continue lower tomorrow and then through the long weekend. The big thing was if VIX didn't spike today and we didn't get the sell on that GDP number, then we could have probably gotten a vol crush into the long weekend because people don't want to hold those options positions if there's no need to into the long weekend and avoid the decay. And then you could have gotten some downside on Tuesday when the market opens, since we're closed on Monday. But since we didn't get that and we got VIX bouncing today, it doesn't look like people want to sell their puts into the long weekend. So they closed some today. I think they'll probably load them back tomorrow, and I think we'll go lower. So we'll see what happens. But yeah, that's all I got.
Yeah, correct. Recent data points, of course, have some impact for Hurst exponents, and that's exactly how it is supposed to change. But those changes should not be very sharp. And if they are sharp, it's also another signal which can tell you a slightly different thing. But because it takes either 1 year or at least 3 months of data, it still is watching the slope of all the movements during that period. But yes, of course, the recent data should strengthen it at least somehow. Okay, Rafael, so what are you trading? What are you thinking about the market?
So yeah, what Brian said, actually, I followed this into the move. That was quite interesting to know all of this while it was happening. So I was watching the SPX above 4100 and expected some reaction there. Worst case scenario I had was 4200. We corrected on the 13th of December. So it was the trigger the way Brian explained. For now, what I'm watching is the volatility actually starting to rise on all US indexes, which is quite interesting. I will try to do some screen share now. Okay, it's working. You can see the screen share.
Yes.
Okay.
I think we can see it, Rafael, but I'm not sure. Oh, yep, there you're good. Yeah, it's showing up on YouTube. You're good.
Okay. So basically, this is the volatility of SPX, and you can see currently that it's rising. So the way it works is when you have a volatility rising like this, what you want to see is a confirmation of trend and then starting to go higher like this. And this is exactly the kind of move that we have currently. It's usually what happens before the start of a volatility spike. You can see what happened before in the previous BMRs. You always get this kind of confirmation and then spike in volatility. And this is currently happening everywhere. You can see that also in NDQ. In NDQ is doing exactly the same thing. So for now, what I'm looking at is the possibility to add on the short side with more conviction. It was a little bit higher yesterday, especially considering that we were still retesting trend, but now we definitely are getting the confirmation that volatility is rising. So the next phase for now, for me, is to look for the best entry to add to shorts. I think this is the end of the BMR. I mean, it's the writing is on the wall. I'm also monitoring VIX currently, the volatility of VIX. And sorry, a lot of lines. So this is a trade for VIX, for instance. And what usually happens is once you start to get the trade approaching trend, it's nearing the bottom of VIX. So you can see that currently we are very near from it. So I don't think it's a very good place to go long. I mean, you can see volatility rising on US indexes. You can see the volatility of VIX reaching the top of its possibilities, meaning a potential bottom in VIX. So currently my mindset is not handling the short doing intraday trading. It's focusing on maybe stopping to unload on the short, but starting to only add to them. So that's what I'm looking at for equities. As for the dollar for now is basically doing nothing. I mean, what you have is a volatility that is just going sideways. It's been trying to go lower. You can see here, this is another way I measure volatility. But for now, I'm waiting. What it's going to do next. MFR is not confirming. Another good thing that happened before the sell-off that we got these past 2 weeks was the upside downside ratio got crushed. Most of them went below 1. It was very good sign that we had the potential for big reward on the short side. It's not the case for DXY. We still have DXY bearish. This morning, for once, we got the upside downside ratio approaching 1, but it's not enough. We want to see more stuff. Another thing I'm monitoring also is bonds. So obviously, I guess most of you have seen what the European bonds have done. So volatility was crushed. The picture for US bonds is different. For now, volatility is still rising on the 2-year, you can see. And on the 10-year, it's trying. So that would be very surprising, especially for people who are long bonds calling for deflation. The big question is, will it start to rise back up or will it go down? This I don't know. This could be the reason why the dollar is still doing sideways action and not finally choosing to move higher as it should. So yeah, that's pretty much what I'm looking at right now. So yeah.
One thing on your tools that's really interesting to me right now, Raphael, and I keep calling it on Twitter is oil, and then around that monthly cosmic trend. So if you want to pull that up, or what you should think about oil right now.
I have a lot of lines on my charts. I need to clean. So yeah, the lines, they are volatility levels. It's based on previous trends. I use them for entry in trade. So basically, the cosmic trend, it's a private joke with Brian, but the cosmic trend actually, it's the one trend that we use for big macro calls. It works pretty nicely on bonds, on oil, on dollar. And currently, this cosmic trend has been trying. The US oil has been trying to break the cosmic trend. So this would call actually a big move for oil to go down. And for now, it's been trying to reject it from below. So we have to wait for the confirmation to be sure. But yesterday was if you think to short oil, yesterday was a good time to try. The current level is 78.59. So we get some reaction these past 2 days. It's not surprising. Market is probably trying to decide if we're gonna go down or up. So
yeah, for me on that, like when you kind of landed on the cosmic trend, we found oil, and then I'm looking at copper showing very similar as well. I'm most interested. I mean, I'm not really shorting oil right now. I'm shorting the energy stocks. So I'm like, next to retail, energy stocks are my biggest shorts right now. It's like XOP, OIH. I got Oxy. I have NOV, and then I'm looking for any other opportunities. Just because these have rallied like way more than oil has actually rallied throughout the duration of this recent BMR and then the year overall. So you've actually had oil like consistently falling since the Russia stuff back in March, and energy stocks have just hung in there. And everyone's long them. I mean, Exxon's the best performing stock this year, right? So these are the ones that I'm really laying into in the shorts, because we really get a break from a cosmic level, a cosmic break on oil, plus all the equity volatility that's potentially coming in the stock market. I mean, you saw today, like oil wasn't actually down that much, but energy stocks got pounded today.
Yeah.
So that's really where I'm looking at those. And then for copper, I like Freeport McMoran, another one I'm trying to short here. So yeah, like I like those. And then obviously, I mean, NASDAQ got crushed today. Like there's a lot of good stuff on the short side, but energy I think has the most potential downside, especially if we're going into like a ongoing transition to deflation. Even if we don't technically reach deflation and bond yields keep rising and we go to stagflation over the next 2 months, that doesn't mean energy stocks are going to work, just because we might be marked still in like a stagflationary environment, because they've come so far, and then equity broadlies are going to so get crushed. And that doesn't mean that oil is going to work just because maybe the PCE report comes in hawkish tomorrow. I mean, oil might probably fall on that type of report, because that means the Fed's going to stay hawkish and continue pressuring oil related commodities. So like energy stocks a lot on the short side here, like with that, knowing that.
Yeah, and another reason why I would not touch things like XLE or energy stocks now is if you look into the correlations, which of course is one of the things that we all use. For example, XLE now has 0.9 correlation to SPY. On a 5-day basis, and on a 10-day basis, it's also quite high. And if you look XLE SPY correlation on a rolling basis, just to see a historical chart, it's relatively high. So now basically, at least in this moment, energy stocks is the same trade as a SPY. So yeah, you don't want to touch that.
So what you mean is the people on Twitter who are short QQQ, long XLE are about to get absolutely annihilated.
Let me check. Well, yeah, QQQ XLE correlation is also 0.89, but you must understand that long short, it's not the most terrible idea, because of course you need to also use for long short, you need to use things like beta, not only correlations, also at least I use those spreads. You can find them on MFR. So, for example, you create spread of QQQ XLE to see where it's going relatively and what the signal is telling for that exact spread. But basically, for those who are, for example, saying, I am not buying SPY, but I'm buying energy stocks because of X, Y, or Z, basically they are buying the same SPY now. I mean yeah. Long short is a different story. So no, if one is longing XLE and shorting SPY for one of the reasons they might have, I mean, it's not the most terrible idea. But you need to use other things, because correlation, especially for long short, correlation is just one of at least 5 other things that you must use in combination. Yeah, so from my perspective, I'm still day trading, mostly futures, and I also received a couple of questions. Hey, why, when you plan to return to like pair trading and the things you did before? And the main problem I see is that I don't get a confirmation from a dollar. Because of course I have a bearish bias on if we are talking on stocks, and I agree with things that Raf said and Brian. I also think that BMR is has ended, or if not, it's very close to an end. But what I don't like is mostly the dollar, and from correlation perspectives, yeah, dollar has still negative correlation to things like SPY and so on, but that correlation has weakened. I mean, negative correlation has weakened. So I don't like that. And for example, now on a 5-day basis, we have UUP SPY at minus 0.11, which for me, I mean, is not a signal at all. So yeah, I'm watching bonds. I'm watching dollar, and another correlation pair, which is very important, TLT UUP. Or you can use any other ETF for fixed income. It doesn't matter. I use TLT. But for example, now TLT UUP 5 days at 0.68 is strongly negative. And knowing the fact that SPY and TLT is at 0.30, so it's positive. Actually, it's what we want to see. But seeing that TLT and dollar is so highly correlated, I mean, it just explains very well why dollar is not performing as we want it to perform. And this is just another red flag for me that I don't want just to, just load up on shorts and hold them, especially in December, because of course, we all know that sometimes, not always, of course, but seasonality also matters. And so I decided that I will wait for dollar. Of course, there's a big chance that we will not get. Maybe euro is now in a bull market, which is only starting, or something like that. Or maybe Dixie will enter bear market. Personally, I don't think so. But if I don't get signal from a dollar, let's say in the first part of January, then of course I will continue to use only correlations and Hertz exponents in total. But for now, I don't want to go against my overall model, and my overall model just says that the best time to short the market, especially US market, of course, is when dollar is not falling. So yeah, so I am trading futures, only futures for now. Usually no overnight risk. Yeah, and I'm using volume profiles and actually an order flow. And actually today's close is something I wanted to talk about, because of course we had some move up before the close, and market today, basically from my tools I use for day trading, bulls won today. Of course, from overall return, you will think, oh no, it's a red day. Of course, how can it be true? But basically, after the cash open, where the overall distribution of volume is, so market closed above that. So basically, at least after cash open, bulls won this intraday fight. So I will see what's going to happen, of course, tomorrow. But that's another thing I want to talk about. That now when I see the order flow and what the volume is doing, not only on a time frame basis but on each tick by tick basis. So yeah, basically this close was not good for bears, and if I had short positions, I would think at least about hedging. Yeah, so, and this regime, I mean, this regime is the same for the last 3 months. We see some chop. We had this BMR correlations, especially dollar correlations, and bonds are not supporting the overall view. Of course, keep in mind that correlations are lagging. So of course, the shorter the period, the shorter the lag is. So first I monitor 5 days. But still, I mean, bonds and dollar positively correlated in this regime. I don't want to load up on shorts. Yeah, so basically that's the main thing from my risk management perspective. And momentum scores also are saying that basically things that are bullish are not overbought, and things that are bearish are still not oversold. So of course, if you combine that with Hurst exponents, of course all those moves can continue, but I don't like to go against the overall macro stuff. And for me, macro stuff is of course basically different compared to whatever's called, but it's for me just basically monitoring fixed income and currencies and seeing where they are heading. And and that gives me a view that I don't know, I can be wrong. Market can fall to new lows immediately in a week or so, but for now I don't want to hold shorts overnight. But yeah, of course, December will end, January will start, and then we'll see. Yeah, so that's it from me now.
By the way, just to address something, we were supposed to have also Matt, Ramadan, and Chris tonight, but so one of them has flu, another one has COVID, and the last one had emergency. So in 2 weeks they will be there. It's just for today.
Yeah, but I think this action between the bonds and dollars really interesting, because what you've had from the course over the last couple of months, through the BMR and that were basically sparked by the inflation reports, was people thinking that inflation's over, right? So that we're going to deflation, disinflation. So bonds and dollar were trading together, which I guess in risk off, I don't know if you'd expect this in deflation, but you expect bonds and dollar to rip at the same time. Kind of sort of what you had today, just bonds didn't really rip, they just went flat. And so, tomorrow with the PCE, but I say, more likely when we get closer to the next CPI reports next month, that's when that's really going to be tested. So right now we have the potential to, between now and the next CPI report, with a little taste of PCE tomorrow, to transition back to that negative dollar bond correlation. But I think that looking at a lot of what the macro guys say, and then, kind of where my signals are lining up, I think you have over the next 2 months, the risk that happens. We go back to dollar and bonds negatively correlated, very similar price action to what you had earlier in the year, not earlier, for most of the year throughout the whole bear market. But then after you get past the next 2 CPI reports and we get closer to the actual recession, then maybe we go back to what you had now. So whether that causes another BMR or whether it causes another absolute drawdown, I think it depends a lot of where stocks are at the time. But this should be really interesting over the next 2 months of how we conflate kind of the inflation regime we've been coming from, then moving into potentially more disinflation. If you're getting a recession, you'd think there's going to be more disinflation. So yeah, so that's what's really interesting. And I think that correlation between bonds and dollar would call that. And another thing, I know you mentioned XLUIWM, that one doesn't do quite good in deflation, but that one's absolutely rips, even mid BMR, and then recently when the drawdown started again. So how are you thinking about that spread?
How I have it in my watch list. So I'm not trading that for the last 2.5 months, I believe, because I just closed all the overnight positions, even spreads. But so market is not signaling deflation at all, based on those relationships, and it's very interesting. So because as you said, that thing is not performing very well, but now it is performing. So those who are modeling markets to forecast inflation and different regimes based on growth and inflation should follow that, because this one is telling us that wait, it's not over yet. That's what I think. And that ripped very, very, very hard. I mean, I missed it. Well, I missed it not because of some other reasons, but just because I'm not trading spreads now. I just decided to stay away from overnight risk. Yeah, but that thing, awesome.
Yeah, like I know once you started talking about it, I started looking at it more less about, because I don't really do much spread trading, but like less about trading it, more about what it means from a macro perspective. It's like Raphael, if you look at XLU, IWM on both your weekly and your cosmic trend, your monthly, that one is almost saying like, no, we're still potentially in a regime where that spread would work, which Vice has said, inflationary regime. So that could bode poorly then for bonds, in the near term, if that thing is just going to keep going.
And of course, another reason, I mean, because, well, based on, all the measures, inflation is going down, but I mean, market participants, can have a different idea, because how you define deflation. I mean, what if inflation will continue to go down, but it will stay at like 6.5 or whatever? Of course, all media sources will yell, "Oh, deflation," but inflation will still be 5%. So that spread can also, take that into consideration.
Yeah, and it's just like you had such a massive drop off in inflation in the last two reports. And so like that can't be sustained unless we're imminently, people are about to get laid off tomorrow in size. And today's jobless claims number didn't show that at all.
Yeah, and I'm still waiting for that. Yeah, like you said, jobless claims are not showing that, and here in Europe, also all the data is still not showing that. I mean, so I was talking about on Twitter Spaces almost every time. Yeah, but same. Raphael said the same thing, that we expect all those layoffs and other bad things for people to happen next year. So in 2023, maybe in the middle of 2023, or at least in Q2. So not even in Q1. So yeah, we're still not seeing that. So I don't know how we can lower inflation even further if people will continue to make money, if wages continue to rise and so on. Yeah, like you said, for these things to regulate itself, and of course markets and economy are quite efficient in the long run to regulate itself out, but we need some relatively bad things for people to happen for economy to regulate itself back again where it is supposed to be.
Yeah, and it's like, it's from a macro perspective, I'm looking at it like that, to where like that's like the near term risk that's going to send stocks lower is the same kind of risk that we had last year, which is inflation still here. Maybe it's not going to be accelerating as hard, but it's still going to be sticky, which means the Fed's going to stay hawkish, which has been the trade all year long. And what's really interesting, like I look at the Fed fund futures, they got on the CME, kind of like the odds for what they're going to hike at the next meeting. Every morning I track kind of what are the odds for 25 or 50 basis points and see how that changes. And right now, like the modal outcome, so the most probable outcome is 25 basis points at the February meeting, and then 25 basis points at the next meeting in March. And just my personal opinion, I'm not a macro talking head or anything like that, but like just my personal opinion, listening to Jerome Powell and just kind of seeing how they react, they're not going to go 75, 50, 25 just like that. That's going to send a terrible message to the market, and they know that. So they're at least going to do another 50 basis point hike. And the correlation between the odds for a larger hike and stocks going down is very high. If you just watch it, you'll see stocks down, odds of a larger hike go up. It's just like that. And so right now, you never see it beyond 80-20, even into a meeting, even when it's a very clear odds that it's going to be 75 in the next meeting. The most it ever goes to is 80% odds for 75 and 20% odds for whatever the other probable outcome, which would be 50. So right now it's been pushing 80% odds of a 25 basis point hike at the February meeting. And it's highly unlikely. And it's not, and that odds hasn't even started moving with stocks drawing down as they have over the past couple of weeks. And so that means that it correlates also to the move in bonds, that this is not Fed hawkishness driven drawdown we've actually seen recently. That still is yet to come, and it could start in the PCE report tomorrow. This drawdown over the last couple of weeks, tax loss selling, maybe some Fed hawkishness, people, whatever it is, it actually hasn't been driven by that macro aspect, which could be another reason why we haven't seen the big bid in the dollar yet. So yeah, so I mean, like those for me, like for example, being short the last couple of weeks and why I'm, pretty confident to kind of remain short here is that like the macro aspect of why you mainly are short, the more probable reasoning hasn't actually really played. This has just been like the initial part of the drawdown. There's still so much more to go, and we're not even near oversold. Like if you look at all the MFR trends, they're still trying to move from bullish to bearish. We still haven't even made that full transition yet. And then once they go from bullish to neutral to bearish, that's when the downside and all the ranges start opening up. And so we still have to go through all that before we mark anything as oversold. So like when I look at the S&P kind of going towards like the low end of its near-term range today, when it was at the lows of today, I'm still not even really interested in covering because I want to be there for the multi-day move when all these catalysts start to play out. And we've seen time and time again, things do go to the bottom of the near-term range. And especially if there's a pending trend breakdown and there's excess long-term downside in the MFR range, you get the big moves the next day, like tomorrow potentially, when you're really breaking down. And what I've found throughout the whole year, like the big money is made when you have size for the big moves. And so you can kind of take some squeezes along the way like we had today, especially when you know that you're in a negative gamma regime. And yesterday's squeeze was all put selling. Today's little bounce intraday was all put selling. There's no real money buying here. And we're not even really that put heavy, especially considering that trends haven't even broke down for this to propel a squeeze more than like what Raphael said, up to like 38.50 or whatever we go. But I don't even know if we get there. And you don't want to like have to try and cover intraday today. At least this is not the way I play it. To cover intraday today with the risk then of missing the big drawdown tomorrow. If you know that the drawdown is going to be realized, not at the end of the BMR, then you cover at the top in 2 months, but over the course of the next week or two, then you can kind of survive a day like yesterday, stay allocated, move the draw, like take the drawdown on the short side. And then when things really start moving, things have gone to bearish trend, you're closer to the long-term ranges, correlations start flipping both on a sector basis and stock bond correlations towards those lows, then you can cover and then wait for a BMR, which is like what you had at the beginning into October. When we were October, like the bottoms, the real bottoms that start a new bear market rally aren't the V bottoms like you had today. The real bottoms that start the bear market rally is like what you had throughout October into November, where it's just basing off of a bottom, going up, coming down, going up, coming down for a couple of weeks at a time. Correlations are weakening through all of that. And then you get the new BMR where it's a trending move to the upside. If we had even closed green today and V bottomed right back up, that I would think that's even less likely the BMR is on when you see that, because that's just, again, put selling. So you have to know, like, we're in a very unstable regime right now where you could get big squeeze tomorrow, big gap down the open today, squeeze intraday today, big gap down the open tomorrow, especially when you have the kind of catalysts overnight. So that's just another way I'm kind of thinking about it.
Yeah, absolutely. I agree, especially on correlations and V bottom parts. Yeah, totally. And at least from correlations, we see no signals of a new BMR starting anyway. So, Raphael, so are you monitoring the chat? Do we have a chat? Or
yes, yes. Sorry, we have the chat on. There's much less viewers than on Twitter, unfortunately, but no questions. So people can ask if they want. One thing though is that the YouTube video is a little bit delayed compared to our live, so it could come a little later.
oh no, that delay is not an issue. Yeah, but the problem is that only channel subscribers can ask questions, I believe. Yeah.
Yeah, I put that as a security. Maybe next time I will remove this one. I thought it was maybe better also to push people to subscribe. But yeah, next time maybe I remove this security. Regarding the fact that maybe jumping the gun of deflation is a little premature. So for instance, one of the play that they are pushing for deflation is obviously bonds, right? But also you have the precious metals like platinum or gold. So for example, when I look at platinum, I can see that in what I see, the volatility is rising. It actually made a higher low on yesterday, higher low yesterday, and now it's making a higher high, the volatility of platinum. So gold looks a little bit better, but I measure the limit where volatility trade could go to, which actually would signal the best place to get out of an asset and expect the volatility to go up and cross this volatility trade. And gold also reached this level yesterday. So it's very interesting to see that bonds are basically flat, and with the potentiality to see yields volatility collapse, which would mean yields up, bonds down, and at the same time you see platinum volatility rising, and gold volatility trade reaching the minimum it could go to before maybe a spike in volatility. So I guess if this is the case, a lot of people are gonna have a bad beginning of Q1 if the regime that they expect, being deflation, do not materialize.
Mhm.
So it doesn't mean that we cannot get a crash, right? We, for example, one famous guy on Twitter have said that what could trigger the puke would be when market participants finally understand that inflation is not going away fast. And that would be the trigger for a big sell of unwinding of bonds position and a panic in stocks with very strong positive correlation between bonds and stock on the crash. So, I mean, in my head, I still think about that. That's why, for example, Brian, I shorted the US oil at the cosmic trend, but it's also in my mind that if this scenario plays out, that inflation goes higher, what happens to oil in that scenario? So, yeah.
I think what we've seen all year. I mean, inflation's been going higher all year, but oil peaked back in March, right? And it's been avoiding the oil short, which so many, I'm pissed that I listed a lot of the macro guys out there about avoiding the oil short because of all the supply chain or, energy crisis, blah, 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 all that. Oil has been one of the best shorts the entire year. If you shorted it up at $120, I mean, that was the play this year from a macro short perspective that no one really got. And, so it's if inflation stays sticky high, that doesn't mean that oil is going higher. If inflation stays sticky high, it's the stickier components like shelters, rent, a lot of things, a lot of stuff that's in the core inflation basket. And if core inflation stays sticky high, that means you're going to have the Fed that's even more hawkish, which is going to get oil down even faster at this point in the cycle, especially because we are going towards closer to the recession where oil dumps every single time, no matter what anyone says. Oil always dumps in a recession. So under that perspective, the oil short should work even if we're in a inflation regime.
Yeah, for sure. I mean, if it was a time to take it, if you didn't take it before, for sure, yesterday was the time to start and try it. I mean, especially, our idea is to hold it until $20 at the end of when the cycle is finally over. So for sure, I'm just I still consider this possibility as a high probable chance. In Q1. Everybody finally understand, oh my god, it's not going lower. The Fed is doing like you said, 0.25% is lunatic. Absolutely, it's going to be 0.5, and now they are starting to worry, okay, now 0.5, maybe 0.5 next time, and what happens then? I mean, for example, when I show you the volatility of NDQ is, we are almost at the lows from from October, and volatility has not started to go up yet. I mean, we are, in terms of vol, I can tell you in terms of where it is, the volatility was the same on the 12th of September. 12th of September, NDQ was at 12,700. So you can imagine now we are at 10,950 and Vola is literally at the same place. So when this thing goes up, it's gonna get absolutely annihilated. I have absolutely no doubt about that. So the question is when, right? The big question is when. And I'm pretty sure we are like 1 week to 2 weeks away. I mean, our hike and volatility of VIX go, especially considering that it's getting now very close to its trade. So it means it has no more room to go up but down. So
yeah, it's just like, well, what's the catalyst to cause a bounce at this point? I mean, they're already pricing in 25 basis points in the next meeting. There's no way they can try to price in no hike in the next meeting. I mean, maybe when there's a will, there's a way with these guys, but like Jerome said, they're going to keep hiking. So that's like, it's 100% probability of a hike. They're pricing in the lower end of the hike. That hasn't even started going up yet. And, you know, everyone that bought puts, you know, but VIX had just an awesome day and they gave it back a little bit to the close because I think they rolled puts lower. But everyone who's bought in puts off of the lows from VIX 19, VIX 20, I mean, what, they're going to sell it all tomorrow or next week? I just doubt it, you know? So it's like the people that are buying puts over the last couple of weeks, in my opinion, you know, they're hedging for the January stuff, which is the CPI report and the Fed meeting and all of that. And so the question of a rally, I think we have to go lower before we see a rally. We have to have like to the point where everyone's flocked for that protection. VIX is up at 30, you know, into those events. And then maybe we can have some kind of real rally that you can time. But like right now, I mean, the market is still very under hedged. If you look at like, so I've been looking at IV rank a lot by. So if you look at it like on SPY, for example, like the IV rank of like the current level SPY, even after today's put buying is only 47%. So like we're right in the middle of where it's been for the last year. When I shorted Qs yesterday, it was at like 15. So like people are not hedging downside, they're not hedging upside either because they just got waxed trying to hedge upside to the CPI report and got absolutely pounded on that. But there's like vol can still go a lot higher, which, you know, doesn't mean that we have to have some massive crash, but it probably means we go back to cycle lows and then we evaluate if when we're back up in the VIX high 20s and 30s and IV rank is up in the 80, 90% level, like then, okay, are we going to bounce again and have another BMR off of that? But any bounces off of here is just people selling puts from a lower level relative to this year. And it's just going to get pounded like it did today on the open. So yeah.
Yeah, I use IV percentile mostly instead of IV rank, but basically it sends you the same message. It's just a different way to show it. Yeah, so I see that and I agree. We have one question on Twitter. I think we already touched on that and actually quite a lot, but still. So the question is, can you talk about the dollar and what you see and are looking at closely for the future? So for the dollar, so. We were talking about the dollar in the beginning, so I don't know, maybe we can do a quick summary or you guys want to add something to what we were talking about the dollar.
I'll add one thing. Rafael can talk about his volatility levels. So like my view on the correlations, like I know you're kind of waiting for the correlation to flip more. I guess it's a higher risk strategy, but I like to go where the correlation is going. And so when I look at like a 5-day correlation on SPY UP, which is like lightly negative right now at -0.1 to -0.2, that tells me that like stocks and bonds stocks and dollar have not been trading negatively correlated that much recently, which means that they should recorrelate soon. And so I would then front run being long dollars and short stock with that trade into a catalyst like tomorrow and even into today, because I expect that correlation to go negative again. And if it's going negative, then you're making money being long dollars and short stock. And then the same thing with the dollar bond correlation. That one even more, I haven't done a refresh at the close, but like I have IEF UUP at a positive 0.96, which is an absolute extreme level versus a positive 0.96 on the 5-day correlation and a negative 0.58 on the 30-day correlation, which means like that one should definitely mean revert and stop trading positive as soon as tomorrow, or at least look for it. And so when I see that actually, rather than the correlation being at extreme, meaning that over the last 5 days it's already happened, I would then front run that correlation, go into that direction and stop in where it's at, which is higher risk, but that's kind of the way I view that for the dollar.
Yeah, this strategy makes sense. Totally high risk, but makes sense. And from a signal perspective, what I'm looking at here, just a quick summary. So now I'm watching basically correlations of two things. So one is TLT UUP, or of course you can replace TLT with any other fixed income related asset if you want. But basically now TLT UUP correlations are very positive, and it's not a good thing, because knowing the fact that SPY TLT is also positive, so and these are the two things I'm monitoring. So of course dollar stocks correlation and dollar bonds correlation. So of course it explains why dollar is not performing as we want it to perform. So basically what I want, and like Brian said, yeah, basically you can just go where correlation is going, but from the exact process perspective that I am always talking about and using, basically there are two things. I want stock and stock bond correlations to continue be positive, and of course if it even increases a bit, even better. But regarding dollar, I want dollar stocks correlation to go more negative, because now, for example, SPY UUP is like negative 0.11 on a 5-day basis, so it's not enough. It's still negative, but not enough from that. And TLT UUP, I wanted to go to, even if it not goes to negative territory, I want the correlations at least to weaken, because 0.68 is not even a signal, because it basically just signaling the other thing that basically now dollar is not along, definitely. So yeah, just a quick recap. Raphael,
to complement what you said about correlation. So the correlations, they are available in my Fractal Range website with a premium subscription, so you can access them, and you can see 5-day return correlation, 15 days and 30 days, right?
Yes.
So you can monitor them there. What I be looking at as well is on MFR, I want to see the upside downside ratio actually become increasingly above 1 in the normal range and the long-term range. And so we talked about this also before. For the first time today at the open, it was very near 1. And what you want to see is this thing to keep on going near 1, and especially above 1. That could signal that potentially the low end of the range is finally set, meaning any move down, if correlation don't move, so it's supposed to be added to. You can go small at the beginning. You don't need to go like a crazy person. Another thing I'm looking at is the volatility of the asset. And what I'm troubled with is since the 5th of December, so I measure volatility in 2 different ways. Since the 5th of December, one of my indicators regarding volatility is saying it's going down. And it's actually going down to levels that we have known during the bull market of dollar. So that's why I'm very surprised that the dollar is going nowhere. But the way I measure volatility on another indicator is saying for now it's flat. So what I would like to see regarding this is, so first, MFR signal to say, okay, now you can start to look back at the dollar, because the upside downside ratio is in your favor. Of course, a change of trend or momentum would be an even bigger signal. That would be a signal to maybe increase the size of your position. You could also wait for dollar to turn bullish. I mean, you can just wait for neutral, wait for bullish, and some people are calling for DXY of $1 to go to the cycle high. You know, so just look at where DXY went during the previous cycle high, and you can get an idea of the final target. So why rush for 2 or 3 points if we are going like 40% higher? And yeah, the next thing I'm gonna look at is definitely the volatility to start making decisive lower high and lower lows. That would be the trigger. For now, unfortunately, I'm not seeing this. I got a buy signal on the 17th of November. It ended up being a fake one because volatility kept rising. For Euro USD, I also got, I think you remember, I got a short 0 minus Euro USD, so a buy, a buy 0 minus 0 Euro USD, so a short Euro USD on the 16th of December. This one is holding. For now, it's the low, so it seems to have been working. But yeah, for dollar, that's what I will be looking at. And yeah, what Vi said, I didn't monitor this, so I'm going to start monitoring this. TLT UUP correlation are now positive, they need to weaken, or even better, they go negative.
Yeah, also one thing I wanted to mention really quickly is that, for example, euro dollar, I mean, euro is very bullish. So that bullish trend now is quite strong. So we need, of course, that to change. But for example, for tomorrow, real-time regular range upside downside ratio is 1.6 for euro dollar. So of course, it's not what you want if you plan to buy the dollar, because euro dollar upside ratio is 1.6. And in the longer term range, it's almost in the middle of the range. Upside downside ratio is 0.92, so also not great. Yeah, but from the long term perspective, yeah, it looks a lot better for shorting in the future than for regular range, because regular range, of course, tells that now is not the time, definitely, because tomorrow you can get squeezed. We have another question. Maybe it's more for a discussion. I don't know if we are able to talk a lot about it, but this is a question for the discussion. Given that US can't really afford keeping high rates because US government funded with 1 and 4 year debt, which is we already 1 year in with a coupon percent went from 15 to 30% of tax collections. So the yield steepener play makes a lot of sense. So what's your view on going long 2-year treasuries versus investment grade credit? Any specific risks you can think about? Why won't we go with higher yields? So this is the question. Also, I sent this question to a market talk chat on Twitter for us. So if you want, you can read that. Yeah, but any thoughts about that?
I don't have Twitter on, so you will have to tell this question regarding so bonds. For now, I'm not touching bonds. That's the first thing I can tell. For the reason I mentioned, the big problem I see in Q1. Basically, inflation is not going away, and maybe something will happen with bonds. As for like longer term view, actually, I adhere to the theory that if the US want to maintain their dominance over the world, they have to reward capital. So, and the issue is, after 20 years of abuse, the lower rates created several issues. First is people are thinking, yeah, maybe I can get some better allocation for my cash because the percentage was not that high. So of course now it's changing. But the other problem that created lower rates was a breakdown in supply chain. Because of the lower rates for many years, the money that was borrowed was invested in a fake economy, and the industry basically collapsed, right? It was transferred to other countries, etc. My guess is the guys in the US are really serious about rebuilding manufacturing, and to do that you need very high rates. You need to reward capital, you need to reward entrepreneur. So I follow a guy on Twitter. Is I think it's at EKTRIT. Chris is his name, and that's his big take on why the Fed has to keep the rates very high. And actually, I believe this. I mean, it makes a lot of sense. If they want to rebuild manufacturing, they need to keep rates very high, etc. So why buy now if it's going higher anyway? I mean, so yeah, that's my take. I don't play it now, so yeah, if you want technical, it's not, you will not get it from me.
I
Yeah,
would
but
rather.
yeah,
ahead.
you saw that question. Yeah, okay.
Yeah. I mean, so my opinion on it, I would rather just, if you want to be short investment grade credit, just a short investment grade credit, and then wait till we get a couple of inflation reports before going long SHY, for example. So if you're trying to be long SHY, short LQD, I'd rather just pick one. I don't know what the value is really in having that spread on. I'm not sure, but if you think bond yields are going higher and that's going to pressure stocks, LQD is going to get absolutely pounded. So you can short that. And then SHY is actually something I'm interested in getting long in like long-term accounts. After like the next two inflation reports, is just load up on a bunch of SHY with 2-year yields up a little higher than where they are now, because then you're going to get closer to the recession. You're getting towards the end of the Fed hiking cycle, and SHY is such low volatility. Whatever downside you might receive from there, additional inflation that stays a little stickier. I like SHY itself from a longer term perspective. I don't think it's going to be a moneymaker. I mean, it could be. I mean, if we just go into deep recession tomorrow and people start getting laid off and earnings are taking a dump and the Fed's cutting rates, SHY is going to rip and you're getting paid a monthly coupon. So I'm actually looking at going long SHY sometime next year, early after maybe the initial onset of the drawdown, kind of like we talked about with like using the same sort of plan that's happened earlier this year, sparking the next part of this drawdown, and then being long SHY and maybe towards the bottom of that. And then if what we're saying is right, if me being short right now, I think like what's going to make me even more right on the short side is if LQD gets pounded back to cycle lows potentially. So yeah, so I'd rather just do it like that.
Yeah, but the very interesting point in that question for a discussion is that the beginning that US cannot afford keeping high rates because their debt is becoming more expensive, which is, I don't think that it's really important statement currently. Yeah, but also quite interesting. Rafael, you don't have what to add, yeah?
Sorry?
You have nothing to add?
No. I mean, if the US has issues with repaying debt, imagine Europe. I mean, so yeah. Everybody has problem paying debts. I mean, it's like this. So
because my answer to majority of questions like that is this: if you want to buy let's say shorter term bonds and short investment grade or whatever, what I do, I always check the signal, because the signal for me is the most important thing. So I create spreads and see what the signal is telling me. So whether it would be a SHY versus LQD or any other spreads, and then I see what signal looks for each single ticker, and then I make my decisions. That's why I usually don't participate in such discussions, because all my trading decisions are based on what I see in a signal and on not what I think about something. Yeah, so. And the shy LQD spread, actually, now I'm looking into it, actually quite interesting, but I'm not sure, quite interesting to which side, to buy that spread or long that, or short that spread. I still need to do more checking on that. Yeah, but actually it looks quite interesting if you check on TradingView or on MFR. So yeah, but I'm a signal person. I mean, so if I see it from a signal perspective, I do add, but I don't know what to add to that discussion. Sorry.
Yeah, one other thing, like with shorting bonds at this point in the cycle, like shorting LQD here, I don't know how much value is really in that, because if LQD is going to puke, stocks are probably going to puke harder at this point, because the harder stocks puke, we're going to get closer to the recession and bond yields will eventually fall. And so it's like, I would just rather, if you want to short LQD, go short Apple, which is considered investment grade credit, right? So I'd rather just short stocks at this point, and then try to figure out when the time is to buy bonds.
Yeah, also agree on that. Okay, Rafael, so are we doing any bets? We have this tradition on Twitter. I don't know if we continue this tradition here.
Yeah, so the problem is every time we do a show, we forget about the previous bet. So I mean, I don't even remember the last one. Was it like how high we go on Speaks or something? I forget. Maybe this time I write it down on paper instead of in the chat, because we talk so much in the chat, then it just goes diluted. Yeah, actually, we could do an easy one because it should happen in the next 2 weeks. I think it's either we go for the easy one, which is will VIX bottom in the next 2 weeks, or we can actually try to nail the bottom. I don't know.
I already know Brian's answer to this. If we asked if VIX bottom in 2 weeks, Brian will say that it already bottomed.
Got it.
Yeah.
I don't know. Yeah. What can we say? For example, yeah, US oil. I mean, it's an interesting one, especially it's at. I saw USO, for example, switch to neutral.
What we do, USO ETF or futures or what?
Yeah, let's go with oil itself. Yeah,
oil. Okay.
Yes, oil. Yeah, just easy one.
Yeah, US oil and TradingView.
So
I see.
Let's say in 2 weeks, is it above or below the current price?
Below. Obviously, you got cosmic trend right above.
Yeah, I know. I'm very afraid by 2 things. First is the position in futures is actually already bearish, and second is Jim Cramer actually said it was a good short. So it's terrifying.
Okay. I'm slightly more worried now.
So yeah, so US oil lower or higher in 2 weeks or 3 weeks, depending on when we do the next show.
I will say higher from futures action. I will say maybe higher.
Lower.
Okay, so I will go with Brian. Lower.
And then a second question: does it go to new cycle lows?
I don't think
no.
So. You mean now or in by the end of the year?
By the end of the next.
Oh no! Come on. Not in 2 weeks. It cannot.
Yeah, 2 weeks. New cycle lows below 70.
No.
Yes.
Okay.
Looking
cool.
for oil to crash here, and then I'm looking for your CAC to crash too. I got into European shorts because I was told that Europe's going to a depression, everything's gonna be great. I should have just loaded up on more NASDAQ instead of your bloody CAC.
Yeah, I'm thinking the issue was what's his name? This guy is a friend of Puff Daddy. He was too much short. So because of him, because everybody had fun squeezing him, we got squeezed because of him. That's my take. And Christine still have our back, but next year she will not have our back anymore. So my guess is next year they will have to jump from the plane without parachute. So
Yeah.
it will be less funny for them.
It'll be really interesting to see what y'all do overnight. I mean, I mean, it's gonna be. I think it'd be a really good sign if Europe just pukes tonight. You know, based on what happened to the US.
Yeah, I still think Q1 for Europe. I mean, it would make no sense. Why would they do this? Front run, Christine. I mean, they know better than this.
When do the boomers sell?
Yeah,
I think that the worst period for Europe will start in Q2, not Q1 next year. Yeah, that's what I'm not talking now about stocks. I mean, stocks can go. Stocks are front running everything. I mean, at least trying usually. But I'm talking about the economy. I think that Q1, Q2. Yeah, maybe we will see signs in Q2. And of course, I'm waiting for layoffs of big companies or at least some other signs. Yeah, but I don't think that it will be in Q1. But you are right regarding stocks, because of course we all know that equities are basically front-looking instruments. So, well, not only equities, basically financial markets are front-looking. So.
But it's amazing
forward-looking. Sorry, yeah, forward-looking, not front-looking. Yeah.
It's amazing for Europe because I mean, you guys, when we watch the US news, I mean, you are talking recession, right? It's like recession is coming. It's been like several months. I turn on TV here. It's like, it's like green flower and puppy dogs. I mean, the only time I hear a recession in Europe, it's when some German guy from the ECB is like, recession is coming. But that's it. I mean, that's the only time I hear recession is coming in Europe. I mean, TV, nothing. Financial news, nothing. It's insane. I mean, they have absolutely no idea where they are going. It's really crazy. At least in America, you have honesty, and maybe that's why the market has been correcting, but the boomers are.
Yeah, I agree regarding honesty. Yeah. Because on the regular news channels, I'm not talking, of course, about business-related channels, but on regular news channels here in Europe, they talk about anything but not recession, of course. Yes.
Yeah, totally. Another thing maybe that now we are doing some narrative and it's just shooting air, but another thing also is maybe because Europe has a lot of safety net regarding social issues. I mean, they will cover, they will how to say cap the price of oil. They give checks for to pay the gas. A lot of stuff now are getting covered. For example, my wife's company. Now the government is literally paying 2/5 of the monthly salary of almost everybody. Yeah, it's fucking crazy. I mean, it's like they ask every big companies if they needed to have some like part-time unemployment scheme, and so of course the company said, of course, they can offload. They are offloading costs, to the government. And the government is picking up check. And why they do this? Because they know that unemployment number going higher means not good rank for president and prime minister. So now they are picking up every bill they can get. It's insane. So that could explain this. That could explain.
That might be why it's rallied so hard.
Yeah, I mean, they are using these checks to buy the CAC.
Yeah, I know, here's some stimulus over there.
But man, it's going to go down so hard. I mean, at some point, it's impossible to see. I mean, you can't defy gravity. I mean, it's a pity Chris is not there today because I'm receiving his newsletter, and the data for Germany is absolutely terrible. It's really, really bad. And I would guess, for France, it's the same. But it's not being reflected in stock. I mean, look, it's been maybe 2 months we talk about that. For 2 months, we have just, we know that it's bad, but it's just keep going. Trend has not changed, in MFR. Still bullish, no change. Momentum is starting to move. We got momentum neutral, and today I just check it's momentum negative. So
on CAC index.
CAC and DAX, so it could be some early signal. And yeah, I need to see at least neutral to make sure I'm not unloading every time we get a big down move. I explained to you why, but yeah,
I think
I want to stop unloading. I just want to short, so we can go to the bottom.
I think it's like my view is like because now I wasn't really sure in Europe at all for a lot of this year, and I kind of got into it. That's just insane how insane the rally's been recently. And it's just like the way I view it, like it's not going to rally if the US is dumping. Like that's just not the way these correlations work. Like if US is dumping, Europe will at least be flat to down if it's really hanging in there. And then there's so many macro problems over there. It's just going to be a ticking time bomb. And then when it goes, like it'll go and it'll catch up to the US.
Yeah, you can see in January, you can compare, see the dump in Europe and see the dump in America in January. I mean, the dump was like straight line down in January. So my guess is we get the same kind of stuff. People just wake up one day and it's just be the dump market orders.
Yep, could be tonight. We'll see. Never know.
Yeah, France looks more interesting now. I'm checking my momentum score. So Germany is already negative from my momentum score perspective, and France is neutral but approaching negative territory. So maybe it can be a sign that it will follow Germany. But from a momentum score perspective, France is still neutral and Germany is already negative.
Because you also have to consider for Europe, you also have to consider the structure of the economy. I mean, France is basically a service economy. I mean, we have 10% of the GDP in industry. So it's not 90%, but a big chunk is service. So of course it's reflected in the stock market, the CAC.
Mm-hmm.
And so service is something that will get hit after the industry has already been hit. But there is no big tech companies in the CAC. Same for DAX. It's not big tech. So that would explain
because big tech companies are not being established in countries with such high taxes like France.
Exactly. So,
of course.
You should be president.
I mean, once I checked the tax system in France, and when I realized that I would never do business there. I mean, it's crazy.
Insane. Yeah, it's insane. It's insane. I mean, and then they wonder why we went from 20% industry GDP to 10% in 20 years. I mean, three genius.
Why all the tech companies are in Estonia or Ireland or some other European countries? Because of taxes.
Yeah. So it takes a brave man to set up a company here. So that could be. I mean, there are many reasons. Christine, the market, the structure of the economies, the fact that the government is now signing checks, and so QT starting next year will be I would guess will be the mega trigger. And you can't hide reality forever. So at some point, people are gonna realize. I mean, you can see. I talk with people every day. I ask them, "How is the bill, etc. Do you see price increase?" Just to make sure the average person is noticing. Yeah, of course, they are noticing. So there's a huge, I'd say, difference between what they say on TV and what you can see from people talking. But 2 months we say this, and for now, still bullish trend, right?
Okay, so I think it was a successful test for the first time. Thanks, Rafa and Bry, for joining, and thanks for watching. And also, this is a message for viewers. Please give us feedback how it went, if everything went well. I mean, if you could hear and see and so on. Also, for next time, maybe we will disable that subscriber filter for YouTube chat, so maybe you will be able to ask questions. All people will be able to ask questions, but of course, as always, as all YouTubers say, that we are not YouTubers. Like and subscribe to the channel.
We need it for the algo.
Yeah, of course, and share this video with others. And so thanks again. Thanks everyone. See you. hopefully in 2 or 3 weeks. Manage your risk, and bye everyone. Thank you.
See you guys. Thank you.
Merry Christmas.
Merry
Merry
Christmas.
Christmas. Okay.